In 2015, two tech outsiders looked at a $5 trillion global industry and realized its fundamental business model was built on a profound, structural betrayal of the human beings it was supposed to protect. It starts with the raw, terrifying fear of losing everything. You wake up to the smell of a house fire, you discover a stolen winter coat, or you stand ankle-deep in water from a shattered pipe. In that moment of absolute vulnerability, you reach for the safety net you have been paying for every single month. You hand over your money to a massive, faceless corporation, believing you have purchased peace of mind and a loyal cornerman for the worst days of your life. But the second you file that claim, the illusion shatters. You realize you have not bought a safety net at all. Instead, you have just paid the entry fee for a brutal, exhausting fight against the very people who promised to catch you when you fall. This rigged bout is not an accident of the system, but the exact mechanism designed to drain you of your stamina and your payout. To understand why this fight is rigged against you from the opening bell, you have to look at the absolute conflict of interest at the heart of traditional insurance. The old giants make their vast fortunes through a very simple, very cold equation. Every single time they say no to your claim, they keep another dollar in their own pocket. Your sudden catastrophe is their financial inconvenience, and your denied payout is their quarterly profit. They are incentivized at the deepest corporate level to delay, deny, and defend their vault against your desperate need. They are not standing in your corner with a towel and a strategy. They are the heavyweight opponent across the ring, wearing brass knuckles under their gloves, fighting you for your own money. Into this broken, hostile arena stepped an unlikely challenger named Lemonade. Daniel Schreiber and Shay Winninger were two tech entrepreneurs who stared at this cold, massive system and saw more than just a bad business model. They saw a deep, emotional betrayal that left ordinary people battered and cynical. They knew that simply creating a slightly faster version of the old system would just be putting a fresh coat of paint on a crumbling, corrupt foundation. They did not want to build just another insurance giant that profited from human misery. They wanted to completely dismantle the arena, rip up the floorboards, and rewrite the fundamental rules of engagement. Stepping into the ring with a $5 trillion monopoly meant the challengers had to forge an entirely new arsenal. They knew they could never beat the heavyweight giants by trading punches under the old, corrupted rules. If they tried to fight a war of attrition, the massive corporations would simply crush them with endless capital and armies of lawyers. So, they changed the weapons, turning to the relentless speed of artificial intelligence and the deep, psychological study of human nature known as behavioral economics. This was not just about using computers to process paperwork faster. It was about programming machines to understand the profound friction between honesty and temptation. By fusing cutting-edge algorithms with a deep understanding of why human beings lie or tell the truth when money is on the line, Lemonade prepared to launch a disruptive strike that the old guard would never see coming. The arena of traditional insurance was built on a brutal, zero-sum game, but Lemonade changed the rules of the ring entirely. They introduced a beautifully simple model to end the constant fighting over payouts. Instead of battling you for every dollar when disaster strikes, they simply take a small, flat fee right at the start. This predictable cut keeps their lights on, pays their staff, and runs their servers, removing the desperate need to deny your claims just to make a profit. The rest of your premium goes into a communal pool, sitting untouched by corporate greed, waiting for the moment you or someone else actually needs it. By severing their own profit from your specific claim denial, they dismantle the ancient conflict of interest that defined the industry for centuries. They are no longer incentivized to keep your money, transforming the relationship from adversaries trading blows into partners sharing a corner. With that flat fee securing their survival, the massive pool of leftover funds demands a totally different kind of management system. This is where the mechanics of the business connect directly to the human heart. In the old system, any money left over at the end of the year was simply scooped up as corporate profit, rewarding executives for denying help. Lemonade flips this completely. If there is money remaining in the communal pool after all the legitimate claims are paid out, the company does not keep a single cent of it. Through a system they call the Give Back program, those leftover funds are donated directly to charities chosen by the policyholders themselves. You are no longer just buying a policy to protect your own apartment or home. You are joining a community where your unused safety net goes on to fund clean water initiatives, local animal shelters, or critical medical research, turning a grudging monthly expense into an engine for global good. Because the leftover money funds causes you care about, rather than corporate bonuses, the temptation to submit a fake claim suddenly feels like stealing directly from a charity. To make this new ecosystem actually work for millions of people, Lemonade had to fire the slow, indifferent gatekeepers of the past and hire entirely new cornermen. Enter the friendly faces of this insurtech disruption, powered entirely by artificial intelligence. When you first sign up, you do not wait on hold for hours listening to elevator music or fill out endless stacks of confusing paperwork. You meet Maya, an AI bot who asks you a few simple questions and gets you fully covered in less than 2 minutes. Maya handles the warm-up, but when the real fight begins and disaster actually strikes, you talk to Jim. Jim is the AI claims bot designed to replace the cold, suspicious human adjusters who used to interrogate you after a tragedy. He is available 24 hours a day, 7 days a week, never gets tired, and never treats you like a criminal for simply asking for the help you were promised. The true power of these digital cornermen is best understood in the darkest moments of a normal Tuesday. Imagine a young person walking outside to find a broken lock hanging from an empty rack, their primary mode of transportation stolen in broad daylight. They are suddenly stranded, stressed, feeling deeply violated, and entirely alone in a massive city. In the old world, this would mean weeks of fighting on the phone, mailing police reports, and begging for a fraction of the bike's value. Instead, standing right there on the sidewalk, they open an app on their phone and simply record a short, honest video explaining exactly what just happened. They speak directly into the camera, their voice shaking with frustration, telling Jim, the AI, the raw truth of the theft. Within 3 seconds of hitting submit, before the victim even starts walking to the subway, a notification pops up on their screen announcing that the full claim has been approved and the money is already in their bank account. That stolen bike claim, resolved in just 3 seconds, fundamentally shifted the landscape of modern insurance. The digital ecosystem had proven that empathy and speed could coexist, leaving policyholders staring at their screens in disbelief while the funds hit their bank accounts. Behind that instantaneous payout is a sophisticated defensive strategy orchestrated by an artificial intelligence named Jim. In the span of those 3 seconds, Jim is not simply guessing or blindly trusting the user's video submission. The AI runs 18 anti-fraud algorithms, cross-referencing thousands of tiny data points, from the user's geolocation and behavioral biometrics to the specific metadata hidden within the uploaded file. This invisible shield is designed to catch fraudulent claims with ruthless precision. By instantly filtering out the liars attempting to game the system, Jim protects the financial pool, ensuring that the honest people are rewarded with unprecedented speed. It is a technological counterpunch that eliminates the traditional, agonizingly slow investigation process. The impact of this 3-second miracle sent a massive shockwave directly into the boardrooms of the legacy sector. Giant, 300-year-old insurance conglomerates suddenly realized that this small, agile underdog was dominating the early rounds of a new market. They watched their market share bleed as younger demographics abandoned the traditional models entirely. People began leaving those cold, painfully slow giants in droves, actively choosing a digital-first platform that actually treated them like human beings, rather than potential suspects. The insurtech disruption was no longer a theoretical threat discussed in quarterly reports. It was a very real, very aggressive reality that was actively siphoning away the next generation of policyholders. But surviving the initial rounds of disruption does not guarantee a championship title, and the reality of scaling a business in this space is incredibly unforgiving. Growing up and attempting to expand across different regions meant crashing headfirst into brutal, ancient regulatory laws that varied drastically across every border. The company had to fight complex legal battles just to operate, facing massive financial hurdles to secure the necessary capital reserves required by law. Lemonade took heavy hits during this relentless expansion phase, bleeding capital and posting significant financial losses as they fought to establish their footing. The cost of acquiring new customers, combined with the sheer expense of adapting their algorithms to wildly different regional risk profiles, tested the absolute limits of their flat-fee business model. They were a lightweight fighter suddenly forced to trade blows in a heavyweight arena. Those early financial losses forced a reckoning within the company, demanding a brutal self-assessment of their survival strategy. The pressure of the public market and skeptical industry analysts weighed heavily on the founders, turning every quarterly earnings report into a high-stakes test of their core philosophy. The underdogs survived this onslaught by relying on the very technology that brought them into the ring in the first place. Every single time a human customer interacted with Maya or filed a claim with Jim, the underlying artificial intelligence absorbed the interaction, learning and adapting from the data. The system studied these millions of data points exactly like a seasoned fighter obsessively watching tape on an opponent, looking for patterns, weaknesses, and opportunities to improve. With every processed claim and every rejected fraud attempt, the neural network grew exponentially faster, smarter, and more remarkably helpful to the end user. They were entirely redefining operational efficiency, turning the heavy blows of early expansion into the very data fuel needed to build an untouchable, constantly evolving digital infrastructure. Beneath the algorithms and the rapid growth, the company uncovered a profound, almost startling truth about human nature. For generations, the insurance industry operated on a foundational belief that customers would always lie to get a bigger payout, creating a toxic cycle of suspicion and denial. But behavioral economics revealed a different reality entirely. When the structural conflict of interest was removed, a strange phenomenon occurred. People simply stopped padding their claims. The mechanics of this honesty were simple but revolutionary. Because customers knew that any unclaimed money at the end of the year went directly to a charity they personally chose, the psychological math completely changed. Stealing from a faceless 300-year-old corporation felt like a victimless crime, but stealing from a local animal shelter or a cancer research fund felt unthinkable. By treating people with genuine trust and aligning financial incentives with human empathy, the company found that customers overwhelmingly chose to be trustworthy. That behavioral shift, first documented in early behavioral science studies by researchers like Dan Ariely, sent a quiet shockwave through the financial world. The realization that a system built on mutual trust could actually lower fraud rates better than an army of skeptical human adjusters left traditional executives scrambling to understand a metric they could not simply buy. Panic set in among the legacy titans, triggering a desperate rush to mimic the upstart they had initially dismissed. Century-old insurance conglomerates began pouring millions into their own digital makeovers, rushing to launch sleek mobile applications and deploying their own automated chatbots. They wanted the speed and the youthful appeal of the digital disruptor, plastering friendly interfaces over their ancient, creaking infrastructure. Yet these superficial upgrades consistently failed to capture the actual magic of the new model. A shiny app could process a form faster, but it could not change the underlying reality that the legacy company still made its profit by holding onto the customer premium and denying the payout. The artificial intelligence of the giants was programmed to protect the corporate bottom line, meaning their friendly digital assistants were ultimately just a new mask on the same old adversarial system. The failure of those superficial copycats proved that technological window dressing could never fix a fundamentally broken business model. Consumers easily saw through the digital facade, leading to massive customer migrations away from legacy carriers and forcing the broader industry to realize that true disruption required tearing down the entire financial structure. The lasting institutional result of this disruption was a permanent shift in how financial startups structure their legal DNA. Lemonade did not just change how claims were paid, it forced a re-evaluation of corporate charters by operating as a certified B Corporation, legally binding the company to balance profit with social purpose. This structural choice proved to Wall Street that a public company could prioritize social impact without sacrificing aggressive market growth. Consequently, a new standard for regulatory approval and investor expectation emerged across the financial technology sector. Venture capital firms and state insurance boards began demanding more transparent operational frameworks from new market entrants, knowing that the closed-loop architecture of the past was no longer acceptable to the modern consumer. The architecture of financial trust had been permanently rewritten, forcing even the most stubborn institutions to slowly adapt their legal and operational standards. Beyond the boardrooms and the shifting regulatory landscapes, the true resonance of this market revolution landed directly in local communities. Millions of dollars that would have traditionally vanished into corporate dividends were instead redirected into the hands of local charities, food banks, and environmental cleanup crews. For the everyday renter or homeowner, the trauma of losing a home to a fire or having a laptop stolen was no longer compounded by a grueling, months-long battle with a hostile adjuster. They were left not just with a fast payout to rebuild their lives, but with the quiet dignity of being believed in their most vulnerable moments. by the time Lemonade rang the opening bell at the New York Stock Exchange in 2020. The century-old architecture of the insurance industry had permanently fractured. The underlying assumption that had governed the market for generations, the belief that the house must always fight the policyholder to survive, had been systematically dismantled. Legacy giants, housed in their sprawling corporate campuses, were no longer just losing younger demographics to a sleek interface. They were losing the fundamental argument of how the business of risk should operate. The aftershock rippled far beyond a single disruptive application or a clever artificial intelligence algorithm. The true seismic shift was the sudden, undeniable proof that trust could be quantified, engineered, and scaled across a global market. The old guard looked at their massive adversarial claims departments and realized that a century of history and billions in capital were no longer unassailable moats against a competitor that had successfully aligned its own financial survival with the basic honesty of its customers. The endless, exhausting 15-round fight in the dark has finally been called. In the quiet aftermath, the most powerful weapon in a multi-trillion-dollar industry is no longer a denied payout, but a simple digital timer stopping at 3 seconds, proving that a business model built on shared humanity can actually win.